Welcome back to the deep dive. We're here to really break down those complex, high-stakes topics in financial reporting,
Hmm.
make them practical, make them exam-ready for you. Now, if you're studying financial reporting, you'll know that time between, say, the year-end, December 31st, and when those financial statements actually get signed off, well, that can be a period of, let's say, high anxiety.
Oh, definitely. And high potential for adjustments, too.
Exactly. It's like
Yeah.
that final quality control check, isn't it? That last step where you have to decide if the financial story you thought you were telling maybe needs a few last-minute tweaks.
Hmm.
And this whole process, it's governed by one key standard, IAS 10, events after the reporting date. Think of it as the filter, the thing that makes sure your financial statements give a truly faithful picture of the company's position at that specific reporting date.
That's a great way to put it. For anyone really trying to master financial reporting, IAS 10 is where you move beyond just mechanically applying rules.
Right.
It forces you into analytical judgment. And examiners, they love it for that reason. They use IAS 10 to test if you understand the core timing principle behind IFRS, not just if you've memorized lists.
So what's our mission today then?
Our mission is to give you a really solid structure. Think of it like a framework, maybe 4 steps, for looking at any event that happens after year end. How to classify it, how to justify that classification with the right kind of language, and then, crucially, how to apply the adjustments or the disclosures needed. Get that right, and you're hitting key examiner requirements.
Okay, sounds good. Let's start by unpacking the standard, maybe first by looking at this critical time zone. When we say an event after the reporting date, we don't just mean anything that happens from January 1st onwards. It's actually a very specific window.
Absolutely specific. It starts, as you said, at the reporting date. Let's stick with 31 December for simplicity.
Okay.
But it doesn't stop until a second very important date. The date the financial statements are authorized for issue.
Right, the authorization date. And that's maybe trickier than it sounds.
It can be, yeah. Students sometimes think it's when the accounts are filed, say, with Companies House or a regulator, but it's not. It's the date when management or the board or whoever has the authority formally takes responsibility for those financial statements. They sign off, they commit to the final numbers.
So for a big listed company, that might be the board of directors meeting and formally approving the accounts.
Exactly. Or for, say, a partnership, it might be when the partners sign them off. The structure of the entity matters here.
Okay, so let's say our year end is 31 December, and the board meets and formally approves everything on February 20th. Then that whole period from Jan 1st to Feb 20th, that's the IAS 10 zone, that whole 7 weeks.
That's precisely the window. And think about the implications. Management is finalizing the report for December 31st, but they have perfect hindsight about everything significant that happened in those 7 weeks.
Right. They know things on Feb 20th that they didn't know or couldn't be sure about back on December 31st.
Exactly. And that's why the standard is so critical, because events happening in that window often shed light on hidden truths about the financial situation at the reporting date.
Like what? Give me an example.
Okay, well, maybe you had a customer, a debtor, who looked a bit shaky on December 31st. Still trading, but maybe slow paying.
Okay.
Then, on January 15th, they file for bankruptcy. That bankruptcy happening after year-end is pretty definitive evidence, isn't it? Evidence that your receivable asset was already impaired when the year actually closed.
Ah, okay. So the post-year-end event confirms a pre-existing condition.
That's the core idea. We need a way to analyze all these things happening after year-end and figure out which ones force us to go back and essentially correct the historical record for December 31st.
Okay, so we've nailed down the when, that crucial window between reporting date and authorization date. Now let's tackle the what's. Let's dive into part 1, the core principles of IAS 10. What's the basic definition we're working with here?
Well, in simple terms, an event after the reporting date is really any event. Could be favorable, could be unfavorable. That happens between the end of the reporting period and that date the financial statements are authorized for issue.
So it's a pretty broad definition initially.
Very broad. It could be internal things like discovering fraud. It could be external market shifts, maybe a major customer going bust, regulatory decisions, legal cases settling, even physical events like a fire or a flood at a warehouse. It covers a lot.
But the crucial thing, the absolute heart of IAS 10 is this split, isn't it? The dividing line between events that make us change the numbers, adjusting events, and those that just need mentioning in the notes, non-adjusting events. Let's start with the first category, adjusting events. What's their defining feature?
Adjusting events are all about evidence. They provide additional evidence about conditions that already existed at the reporting date.
Okay, conditions that existed.
Yes. I like your earlier analogy of a photograph taken at midnight on December 31st. At that exact moment, some things in the photo might be a bit blurry. Maybe the precise outcome of a court case is uncertain, or the true collectability of a specific debt, or maybe the real selling price you'll get for some old inventory.
So there's uncertainty at year end.
Exactly. Then an event happens after year-end in that IAS 10 window that brings those blurry bits into sharp focus. It confirms the exact amount of a legal settlement, or proves the debt is uncollectible, or shows what that inventory really sold for.
The underlying issues, the lawsuit, the risk the customer wouldn't pay, the potential inventory write-down that was already there on December 31st.
Precisely. The condition existed. The event after the reporting date just confirms or measures that pre-existing condition.
Okay.
And this really ties back to the fundamentals, The conceptual framework talks about faithful representation. We want the accounts to show the true economic reality of the company at that specific moment, December 31st.
So if we get better information later about something that was true back then,
We have to use it. It's not optional. If we know before authorizing the accounts that a debt existing at year-end is definitely bad, or a provision we made was too low, we must adjust. If we didn't, our balance sheet would be knowingly wrong about the value of assets or liabilities that existed at year-end.
that makes sense. We're essentially perfecting that historical snapshot, using information that clarifies what the picture truly looked like then.
Exactly. Perfecting the snapshot. I like that.
So what about the other side of the coin? Non-adjusting events. How are they fundamentally different?
They're different because they relate to conditions that arose after the reporting date. The key is that the circumstances on December 31st were different. The condition didn't exist then.
So like the asset was fine on December 31st, the customer was okay then, a big strategic decision hadn't actually been made yet.
Exactly. Think about a major fire destroying a factory on January 10th. On December 31st, that factory was presumably fine, operational, correctly valued. The fire's a new condition that arose after the reporting date.
So if we treated that fire as non-adjusting, we're effectively saying, look, the financial position we reported for December 31st was accurate based on everything we knew then, this fire. That's a significant event, but it affects the next year's story.
That's the perfect way to think about it. Non-adjusting events reflect things like new business decisions, like issuing shares, new market changes, or new catastrophes. If you adjusted the December 31st accounts for these, you'd actually misrepresent the financial position of that prior period.
Like your example earlier, if a company issues shares in January, putting that cash on the December 31st balance sheet would be wrong. It would look like they had resources they simply didn't have at that date.
Precisely. It would violate faithful representation of the past period.
Just because we don't adjust the main numbers doesn't mean we just ignore these events completely,
Right.
especially if they're big things, like a fire.
Absolutely not. This is where the other side of the conceptual framework comes in relevance. While non-adjusting events don't change the balance sheet or income statement numbers for the past year, if they're material, meaning they're significant enough that knowing about them could influence the decisions users make based on the financial statements, like deciding whether to invest or lend money.
Okay.
If an event is material, even though it's non-adjusting, it must be disclosed in the notes to the accounts. You need to tell the users about the fire or the major acquisition announced in January, even if those facts don't change. The profit figure for the year ended December 31st.
Just took a balancing act.
It is. You balance faithful representation of the past, don't adjust for new conditions, with relevance for the future. Do disclose significant new conditions. The accountant's job is to get that balance right.
Right. That distinction is crystal clear now. Adjusting evidence of past conditions. Non-adjust new conditions arising later. Let's make this really practical now and apply it to specific scenarios. Because, this is where the exam marks really are, isn't it? Getting the application right.
Absolutely. This is part 2, digging into adjusting events, the ones that make us go back and actually change the numbers in the accounts.
And the logic, as we said, is if something was uncertain or estimated at the reporting date, the event afterwards provides the necessary certainty or measurement.
Correct. Let's start with a real classic exam scenario, one that often links IAS 10 with another key standard, IAS 37 on provisions.
Okay, case 1. Legal disputes and settlements. How does this work? Let's say there's a court case ongoing at year-end.
Okay, imagine a company, Apex Corp. They're being sued for, say, breach of contract. Importantly, that lawsuit was filed before December 31st. The legal process is underway.
So the potential obligation from a past event, the lawsuit definitely existed at year-end.
Definitely. Now, on December 31st, Apex's lawyers look at it. Based on IAS 37 rules, they decide a loss is probable, and they can make a reliable estimate. Let's say you estimate the likely cost is somewhere between $50,000 and $100,000. So they make a provision for their best estimate within that range, say $75,000.
Okay, so 75K provision booked at Dec 31st based on an estimate.
Exactly. Now, fast forward to January 10th. This is after the reporting date, but before the financial statements are authorized. The court reaches a final verdict. Apex Court is ordered to pay exactly $95,000 in damages and costs.
So the uncertainty is gone.
Precisely. That court verdict on January 10th is an adjusting event. Why? Because it provides definitive evidence about the amount of an obligation that already existed at December 31st. It didn't create the obligation, it just measured it accurately.
And the accounting treatment follows directly from that.
It has to. We must adjust the accounts. We increase the provision from the estimated $75,000 up to the actual $95,000 and that extra $20,000. That gets recognized as an expense in the profit or loss statement for the year ended December 31st. You see how it links back. We had the IAS 37 present obligation, and the IAS 10 event provided the better measurement needed to finalize the accounts for that period. Failing to adjust would mean understating both the liability and the expense for that year.
That's a really clear example of how the standards work together. Okay, let's move to case 2, recoverability of assets. Specifically thinking about a customer, a debtor, going bankrupt after year-end.
Yeah, this is another very common one. It tests your understanding of impairment, often linked to IFRS 9 for financial assets like trade receivables, but the principle is broader.
So, the scenario. We have a customer, Beta Ltd. They owe us, say, $150,000 at December 31st. We knew they were maybe struggling a bit, paying late, but still trading. Then, January 25th, again before the accounts are authorized, Beta Ltd. Officially files for bankruptcy.
Right. Now, the crucial question the examiner wants you to wrestle with is, did the reason for the bankruptcy, the underlying financial difficulty, exist at December 31st?
And usually the answer is yes. Bankruptcy doesn't just happen overnight.
In the vast majority of cases, yes. The formal bankruptcy filing is usually the final confirmation of financial distress that's been building for some time. The slow payments, the difficulty, those were indicators. The company was likely already facing problems at the reporting date. The bankruptcy filing is just the definitive proof that our $150,000 receivable was impaired, probably significantly, back on December 31st.
So the bankruptcy confirms the pre-existing impairment condition.
Exactly. Therefore, it's an adjusting event.
But what about, okay, here's a tricky one. What if Beta Ltd. Looked absolutely fine on December 31st? Good cash flow, meeting payments, then boom, January 10th, a massive, totally unexpected earthquake destroys their only factory. They have no insurance, and they immediately go into liquidation because they just can't operate.
That's a great counterexample, and that highlights where judgment comes in. If you could argue convincingly that the debtor's financial collapse was solely and directly caused by a major unforeseen event that happened entirely after the reporting date,
Like the earthquake.
an event whose conditions did not exist at year-end, then you might classify the resulting bankruptcy as non-adjusting. The receivable was fine on December 31st. The earthquake was the new event. It would likely require disclosure, of course.
But that's the exception, not the rule.
Generally, yes. You'd need strong evidence to argue the company wasn't already vulnerable. If they had high debt or weak cash flow before the earthquake, you'd probably still argue the earthquake just tipped them over the edge. The underlying vulnerability was the pre-existing condition.
Okay. So, assuming the more typical scenario, the bankruptcy confirms pre-existing difficulties, what's the accounting treatment?
Adjusting event. We need to write down the trade receivable to its recoverable amount as at December 31st. This usually means recognizing a bad debt expense, or an increase in the allowance for doubtful debts, and the profit or loss for the year ended December 31st. If it looks like we'll get nothing back, we might write off the full $150,000. The key is ensuring the asset isn't overstated on the balance sheet date.
Right. Matching the expense to the period where the impairment effectively occurred.
Okay.
Next up, case 3, inventory valuation. This brings in IAS 2 and the concept of net realizable value, or NRV.
That's right. IAS 2 is clear. Inventory must be valued at the lower of its cost and its net realizable value. NRV is basically what you expect to sell it for, minus any costs needed to finish it and sell it.
And the problem is NRV is often an estimate at year end, right?
Correct.
You don't know for sure what you'll get until you sell it.
Exactly. So let's use the example from the source material. We have inventory on the books at December 31st with a cost of $25,000. Management thinks it's worth at least that.
Okay.
But then in mid-January, before the accounts are signed off, that specific inventory is sold and it only fetches $15,000.
Ouch. So much less than cost.
Much less. That actual sale price of $15,000 happening shortly after year-end provides really strong objective evidence. Evidence about what?
Evidence that the NRV back on December 31st must have already been below the cost of $25,000.
Precisely. The low selling price tells us something about the condition of that inventory at year-end. Maybe it was becoming obsolete, maybe it was slightly damaged, maybe market prices were already falling. The reason doesn't matter as much as the fact that its recoverable amount was impaired then.
So even if management genuinely thought on Dec 31st they could sell it for $26,000, the actual sale proves that belief was wrong.
Correct. The subsequent sale gives us the better evidence about the value at the balance sheet date. It's an adjusting event.
And the treatment.
We have to adjust the inventory value down. We recognize a loss of $10,000, the $25K cost minus the $15K NRV confirmed by the sale. That $10,000 loss typically goes through cost of sales, reducing the profit for the year ended December 31st, again, preventing the overstatement of assets.
Makes sense. Okay, case 4. This one sounds a bit more dramatic. Discovering hidden problems like fraud or significant errors after year end.
Yeah, definitely not something management wants to find, but it happens. Let's say during the final audit checks in February, before authorization, they uncover a pretty sophisticated fraud. Maybe someone was inflating sales figures and creating fake receivables back in December.
So the financial statements as drafted for Decade 31st were materially wrong.
Exactly. The fact that the accounts were misstated due to fraud or error clearly existed at the reporting date. The discovery in February is just the event that brings this pre-existing condition to light.
Now, this sounds like it might stray into the territory of another standard, IAS 8, which deals with errors. How do IAS 10 and IAS 8 interact here?
They work together perfectly. The discovery of the fraud or error during the IAS 10 window makes it an event after the reporting date. Because that event provides evidence of a condition, the error fraud that existed at the reporting date, IAS 10 classifies it as adjusting.
Okay, so IAS 10 says adjust. Then what?
Then IAS 10 effectively hands over to IAS 8 for the treatment. IAS 8 tells us how to correct prior period errors.
And how do we correct material errors under IAS 8?
Retrospectively. That means you go back and fix the numbers for the reporting period you're about to issue. The year ended December 31st in our example. You correct the sales, the receivables, the profit, whatever was affected. And if the error also affected the previous year's figures that you're showing as comparatives, you have to restate those too.
Wow, okay.
Yeah.
So it can be quite significant.
It can be very significant, but it's essential for the integrity of the financial reporting. The discovery event is the IAS 10 trigger confirming the condition the error existed. The correction follows IAS 8 rules. It's a prime example of a post-period discovery confirming a fundamental flaw in the past position.
Got it. Right, one last adjusting event example. Case 5, dealing with valuations specifically for property, plant, and equipment, PPE, and impairment. We need to be careful here to distinguish this from, say, a building burning down after year end, which we'll come to later.
Absolutely. This is about confirming impairment that was potentially already there. We need to think about IAS 36, impairment of assets. So imagine a company owns a large office building. On December 31st, maybe there are signs of potential impairment. Perhaps occupancy rates in the area have plummeted, or a major tenant announced they're leaving. These are indicators under IAS 36 that the building's recoverable amount might be less than its carrying amount on the balance sheet.
So the potential problem, the impairment indicator, existed at year end, but maybe they don't have a full formal valuation done right then.
Exactly. Let's say they commission a formal valuation and they get the report back on January 20th. Again, after year end, but before authorization. And that report confirms, yes, the value has dropped significantly, say by $500,000, directly due to those market conditions that were evident at year end.
So the valuation report is the evidence confirming the extent of the impairment.
Precisely. The adverse market situation suggesting impairment was present on December 31st. The subsequent valuation just quantifies the loss that had effectively already occurred by that date. Therefore, it's an adjusting event.
And the treatment.
You recognize the impairment loss of $500,000 in the financial statements for the year ended December 31st. Where it goes profit or loss, or maybe against a revaluation surplus if one exists for that asset, depends on the specifics of IAS 36 and how the asset is accounted for. But the key point for IAS 10 is you recognize the loss in the period ended the December 31st because the condition causing it existed then.
Okay, but let's contrast that. What if, on December 31st, the building was fine, fully valued, no impairment indicators? Then, on January 5th, the local government suddenly announces they're building a huge, noisy waste recycling plant right next door, and the property value instantly tanks.
Ah, perfect contrast. That government announcement on January 5th is a new event. It creates a new condition that negatively impacts the asset's value going forward. On December 31st, the building was correctly valued based on the circumstances then. So the value drop caused by the January 5th announcement would be a non-adjusting event.
But presumably material, so it would need disclosure.
Absolutely material. You'd have to disclose the nature of the event, the announcement, and the estimated financial impact, the drop in value in the notes. But you wouldn't adjust the December 31st carrying amount of the building. It just shows how critical the timing of the underlying cause is. Did the cause exist at year end, or did it arise afterwards?
Okay, we've spent a good amount of time on fixing that historical snapshot, the adjusting events. Now let's flip the coin. Part 3. Non-adjusting events. If adjusting events are about correcting the past picture, these seem to be more about telling users important news about the future without messing up the past results.
That's exactly right. The logic remains strictly chronological. These events happen because of conditions that arose after December 31st. Adjusting the prior year's numbers for these would actually violate faithful representation of that past period.
So the focus shifts completely. It's not about changing the P&L or balance sheet figures for the year just ended. It's about providing clear, relevant information in the disclosures in the notes.
Precisely. Robust, relevant, and, where possible, quantified disclosure becomes the key.
Let's look at some examples. Case 6. Changes in capital or financing. Things like issuing new shares, or maybe taking out a major new loan after year end. The source example mentions a company issuing 100,000 new shares and raising $200,000 shortly after the reporting date.
Yeah, this is a textbook non-adjusting event. Think about the sequence. The decision to issue shares, the actual process of selling them, the cash coming in, the change to the company's equity structure. These are all things that happened after December 31st.
Right. On December 31st, that extra $200K cash wasn't there, and the share capital was lower.
Exactly. So if you were to adjust the December 31st balance sheet to include that $200K cash and the corresponding increase in equity, you'd be giving a completely false picture of the company's resources and capital structure at that date.
So definitely non-adjusting. But it's obviously important information for someone reading the accounts.
Hugely important. It's clearly material. Knowing the company raised $200,000 soon after year-end affects how you might view its liquidity, its investment plans, maybe even calculations like earnings per share going forward. So while it's non-adjusting for the main statements, IAS 10 mandates disclosure. You need a note explaining the share issue, what happened, when, how many shares, how much cash was raised.
Okay, what about dividends? This often seems to trip people up.
Yeah.
Say the board meets on February 1st and recommends paying a dividend based on the profits earned in the year ended December 31st. Is that adjusting?
Yeah.
Because it relates to last year's profits.
Ah, good question. And you're right. It's a common pitfall. The answer is no. The declaration or proposal of a dividend after the reporting date is non-adjusting.
Why not? It feels linked to the past year.
It feels linked, but the key accounting principle here, usually drawing from IAS 37 again on obligations, is when does the actual liability to pay the dividend arise? A liability only exists when the company has a present obligation. For dividends, that obligation typically arises only when the dividend is formally declared and approved, maybe by the board, or sometimes it needs shareholder approval. If that approval happens after December 31st.
Then there was no actual obligation, no liability on the balance sheet date.
Exactly. There was no liability to pay it at December 31st. So you don't book a liability on the December 31st balance sheet. It's a non-adjusting event. But again, if it's a significant dividend, you absolutely need to disclose the proposal in the notes, the amount per share, the total expected payout, so users are aware of this upcoming call on the company's resources.
Okay, that clarifies the dividend issue. Let's move to case 7, which you mentioned earlier, major asset changes, particularly losses like fire or flood damage occurring after year end. This is where we need to be really clear on the difference between this and the impairment we discussed as case 5.
Yes, the distinction is critical. Let's use that stark example from the source. A building, correctly valued at $500,000 on December 31st, is totally destroyed by a fire in January. Worse still, it turns out it was only half insured.
Okay, so a potential $250,000 uninsured loss.
Right. Now, apply the IAS 10 logic. On December 31st, what was the condition of the asset?
It was fine. Operational intact, worth $500,000.
Exactly. The fire. That happened in January. It was a catastrophic new event, creating a new condition, the destruction of the asset, that arose entirely after the reporting date.
So if we tried to write down the building's value on the December 31st balance sheet, or recognize that $250K loss then,
You'd be fundamentally misrepresenting reality. You'd be implying the company only owned half a building or a damaged building on December 31st, which simply wasn't true.
so non-adjusting is the only way to maintain faithful representation of the December 31st position.
Absolutely. The event is new, the condition arose later, but is it material?
Oh, definitely. Losing a $500K building with a $250K uninsured hit is huge.
Exactly. Highly material. So even though it's non-adjusting, it demands very clear and specific disclosure in the notes. We have to respect the historical accuracy of the DAC 31st numbers, but we also have to inform users about this major change that will significantly impact the company's future asset base, operations, and cash flows.
And the disclosure needs to be specific, right? You can't just say a building burnt down.
No, IAS 10 is quite clear on this for material non-adjusting events. The disclosure needs to include, as a minimum, 1, the nature of the event, what happened, fire, when, a date in Jan, what asset was involved, the building, and 2, an estimate of the financial effect.
So in this case, stating the $500K carrying value destroyed and the expected $250K uninsured loss.
Precisely. Or if for some reason you couldn't reliably estimate the financial impact yet, which seems unlikely for an uninsured loss, but maybe for complex consequential losses, you'd have to state that an estimate cannot be made and why. But you must address the financial impact. This allows users to understand the magnitude of what's happened after year-end.
Okay. Final category of non-adjusting events. Case 8, significant operational changes. This sounds like big strategic stuff.
It is. Think about major decisions that change how the company operates or is structured, but where the decision or announcement happens after year-end. Examples include deciding to buy a major new subsidiary or asset, formally announcing a plan to discontinue a whole segment of the business, or announcing a large-scale corporate restructuring program.
So let's take the asset purchase. Management decides on Jan 15th to buy a huge new factory for $10 million. Maybe they've been thinking about it for months, but the deal is signed on Jan 15th.
Right. The key is, when did the actual commitment or obligation arise? Even if they were planning it on the 31st, the legal obligation to pay the $10 and the right to receive the factory didn't exist at that date. The signing on Jan 15th is the event that creates the new asset and liability or commitment. That's a post-period event.
Not adjusting. What about restructuring? Say, management had secretly been planning for ages to shut down a division, but they only formally announced it to the public and employees on January 2nd.
Okay, this again links back to IAS 37 rules, this time on constructive obligations for restructuring. Generally, a liability for restructuring costs only arises when 2 conditions are met. The company has a detailed, formal plan, and it has raised a valid expectation in those affected that it will carry out the restructuring.
And the raising expectations bit usually means announcing it?
Yes, typically by announcing the main features of the plan publicly or to the affected employees. So if that announcement or the start of implementation happens after December 31st, then no liability for the restructuring costs existed at year-end.
So again, non-adjusting.
Non-adjusting. These are all decisions fundamentally about the future shape, profitability, and operations of the business. They're not providing evidence about the value of assets or liabilities that were on the balance sheet at December 31st.
But like the fire, these sound like things users definitely need to know about.
Absolutely. Announcing the closure of a major division or a huge acquisition, these are highly material strategic shifts. They drastically affect future prospects, cash flows, and how someone would analyze the company. So even though they're non-adjusting in terms of the December 31st numbers, they must be disclosed in the notes. You explain the nature of the decision, e.g., restructuring plan announced, division to be closed, and provide an estimate of the expected financial consequences. For example, estimated closure costs, expected impact on future revenue. Disclosure is vital for relevance here.
Right. We've covered the theory, the core principles, and walked through a lot of really helpful examples of both adjusting and non-adjusting events. But knowing the rules is one thing. Getting the marks in the exam room is another. Let's shift focus now to part 4, exam strategy, and avoiding common pitfalls.
Yes, this is absolutely crucial for listeners preparing for their FR exam because honestly, students often lose marks here not because they picked the wrong category adjusting or non-adjusting, but because they didn't explain why properly.
Okay, so let's focus on examiner expectation 1, classification and justification. Why isn't it enough just to write adjusting event?
Because the examiner needs proof you understand the principle behind the classification. Simply stating the answer gives them no insight into your reasoning. You have to explicitly connect the event back to the core IAS 10 definition.
So what does a good justification look like for an adjusting event?
For full marks, you need to use the key phrases. Your justification must say something like, this event, example, the bankruptcy of the customer, provides additional evidence of a condition, for example, the impairment of the receivable that existed at the reporting date. You need that explicit link. Evidence condition existed at reporting date. That phrasing shows you've grasped the historical adjustment concept.
So really hammering home that it relates to the past condition, not just the event itself.
Absolutely. Frame it around the condition at Dixon 31st. And conversely, for a non-adjusting event, the justification needs to be equally precise, but the other way around.
How so?
You need to state clearly that the event, example, the fire, relates to a condition that arose after the reporting date and therefore did not exist on December 31st. Again, using that specific language, arose after, did not exist at reporting date, signals to the examiner that you understand why it's not being adjusted. It's like a language code you need to use.
Okay, use the examiner's expected vocabulary. Got it. Now, examiner expectation 2 was about getting the disclosure wording right, specifically for those material non-adjusting events. We touched on this, but let's reinforce it. 2 components are needed.
Yes, 2 essential parts to the disclosure note. First, describe the nature of the event. Be specific. Not just asset purchase, but maybe on 15 January 20X6, the company entered into a binding agreement to acquire Plant X for $5 million.
Okay, nature of the event. What's the second part?
An estimate of the financial impact. You have to quantify it if possible. For the fire example, we said disclose the $500K carrying amount destroyed and the $250K uninsured loss. For a restructuring announced after year-end, you'd state the estimated costs, say, $4 million in expected redundancy and closure costs likely to be incurred in Q1 20X6.
What if you genuinely can't estimate the financial impact yet? Say the consequences of a legal ruling that just came out are still really unclear.
You still have to address the financial impact element. In that situation, IAS 10 requires you to state that a reliable estimate of the financial effect cannot be made, and briefly explain why. You can't just ignore the quantification requirement. The examiner wants to see you've considered it. So either provide the number or explain why you can't.
Okay, that's clear. Nature and financial effect. Now let's talk pitfalls. Where do students most often go wrong with IAS 10 in the exam? You mentioned one earlier.
Yes, a really common error is mistaking events that simply confirm management's plans or expectations about the future as adjusting events. This seems to be where the subtlety catches people out.
Give me an example of that confusion.
Okay, management might have been planning to refinance a major loan for months, maybe since November. They were pretty certain they'd get it done early in the new year on better terms. The new loan agreement is finally signed on January 10th.
Okay.
Some students might think, well, they planned it before year end, so it relates to conditions then, but that's wrong. The plan existed, yes. But the actual contractual obligation under the new terms, the new interest rate, the new repayment schedule, that liability, didn't exist until the agreement was signed on January 10th.
So the plan isn't the condition in the IAS 10 sense.
Exactly. The condition needs to be something that affected the financial position at the reporting date, like an existing impaired asset, an existing legal obligation, an existing error in the accounts. A plan about a future transaction, even a highly probable one, doesn't meet that test. The new loan terms arose after the reporting date, so non-adjusting, but likely requiring disclosure of material.
So the key takeaway here is management certainty, or a high probability about something happening in the future, is not the same as a condition existing on the balance sheet date.
That is probably the single most important distinction to grasp for avoiding this common pitfall. IAS 10 is fundamentally historical. Adjustments are about getting the past right, based on new evidence about past conditions, things that change the future, new contracts, new strategic moves, new market events like interest rate changes happening after year-end are generally non-adjusting.
What about something like a big change in foreign exchange rates just after year-end? Say a company has a large receivable in euros on Dixon 31st, valued using the Dixon 31st spot rate. Then in the first week of January, the euro plunges against the reporting currency. adjusting?
Generally, no. That change in the exchange rate is a market movement, a new economic event that happened after the reporting date. The receivable was correctly valued using the closing rate on this 31st, as required by the relevant standard, IAS 21. The fact the rate moves significantly on January 5th impacts the value going forward in the next accounting period. It's a non-adjusting event.
Unless, is there ever an exception?
Well, the only tiny exception might be if you discovered the exchange rate you used on December 31st was actually wrong, like a calculation error. Discovering that error would be adjusting under the IAS 8 link we discussed, but the market's simply moving after year-end. That's a new condition.
Okay, so it really all boils down to that one core question, doesn't it? When you look at an event that happened after year-end, you have to ask, does this give me new information about the value or existence of an asset or liability that was on the balance sheet on December 31st? Or is this genuinely a new event, a new piece of information about something that happened after December 31st?
That is the absolute litmus test. If the balance sheet was right on December 31st, based on the conditions and evidence then, subsequent events, if material, only need disclosure. If the balance sheet was actually wrong on December 31st because of an impairment we didn't fully quantify, an obligation we underestimated, or an error we hadn't found and the post-balance sheet event proves it was wrong, then we must adjust. Nail that timing logic, understand that core question, and you'll be well on your way to mastering IAS 10 for the exam.
So just to kind of wrap things up from this deep dive, mastering IAS 10 really is essential, partly for exam success, obviously, but also because it forces you to really think about those fundamental accounting principles, doesn't it? Like faithful representation and relevance.
Yeah, it brings them to life. Adjusting events, they're like the guardians of historical accuracy, using that later evidence to make sure the past record is as true as possible.
And the non-adjusting events, well, they protect the integrity of that past period's results. They stop you distorting history. But they also make sure users get timely warnings about big things happening next. And we saw just how vital that justification is. It's not enough to know if it's adjusting or not. You have to be able to articulate why, using that precise language about conditions existing or arising after the reporting date. That's where the analysis marks are won.
Absolutely. That linkage is key.
You know, thinking about this, since deciding if a condition truly existed back on December 31st often involves quite a bit of management judgment, it does raise an interesting point.
What's that?
Well, what about the pressure on management? If they know something bad is coming down the track in January, maybe a big contract loss is inevitable, how strong is the temptation to argue the condition didn't really exist back in December so they can push the bad news into the next period via disclosure, rather than adjusting the current year's profits down?
That's the ethical dimension, isn't it? The standard provides the technical rules, but applying them, especially in gray areas, requires integrity. Management has a responsibility to use the available evidence honestly to reflect the economic reality at the reporting date, not just to manage the reported numbers.
So it's where technical accounting meets that need for genuine transparency.
It really is a crucial intersection.
Well, hopefully this deep dive has given everyone listening a really solid structure for tackling IAS 10 questions. Remember to practice classifying events, but more importantly, practice writing out those full justifications using the key phrases we discussed.
Yes, practice applying that core test relentlessly.
And remember, this deep dive is just one part of the ongoing SmartPass series, where we break down key IFRS and financial reporting standards. There's more to come. Definitely check out the video description for links to other SmartPass study resources to help with your FR preparation. And of course, if you found this useful, please subscribe to the SmartPass YouTube channel for more expert guidance and practical exam tips. Thanks for joining us on the deep dive. We'll catch you on the next one.